had a heck of a roller coaster with the economy and with you here and our predictions and everything else. And so I think just leading into today, part of the conversation is like, what a roller coaster we've been on. And we kind of expected it a little bit.
Coming into this year, for certainty.
But this is where everybody's at today. So Godspeed and good luck.
Yeah.
My first answer to all your questions is I don't know.
Yeah.
But we're going to talk about it anyway. And see if we can maybe get to some answers together here.
Like a true banker. All right. Well, everybody, welcome Antonio back. We appreciate it. I was saying how much we talk about this before and after. Right. That's all we told him he was allowed to bring. Two to the left. Thank you. Perfect. Oh, hey, look, it's you. You updated your photo.
I know, I did.
Thank you.
Your teasing.
Yeah.
But you guys did me dirty.
It only took a year and a half.
After my last time up here, so I wanted.
We did you dirty? No.
I'm like mid-hand.
Sean doesn't do anybody dirty. Okay. Might have. All right, let's hit the next one because I think this is a great. Wait, what happened? Oh, hang on.
What'd you give me?
We got to do a.
This is the name of our mid-year outlook.
Yeah.
It is called Comfortably Uncomfortable. From what you guys were leading into this with, it sounds like we're more on the uncomfortable side of things. But the markets as a whole have not overreacted. Obviously, we had quite a journey in April, but things have kind of come back to really where they started, at least for the U.S. stock market. So that was the meaning for the title.
So hang on, back up a second though,
Sure.
because back when we were here presenting the 2025 outlook, right, and the bank puts these two big documents out, and then we talked a lot about this article, which was put out by Michael Semblist, who is the global investment research head and all these things,
Correct.
and he's been there forever. But he called this. He wrote this great piece. These don't get too heady. You can actually. They're fun reads. There's a podcast called Eye on the Market that's worthwhile getting. And it's relatively short, lots of charts. But he said, we're basically putting all these things together right now at once, whether it's Doge, tariffs, deregulation, deportations, tax cuts, cost cutting, crypto, medical freedoms, oil and gas, all these things are coming together. All these changes to the economy in the world are happening, in the U.S., are happening at one time. Something's going to break. And he calls in this article, in this paper, which he wrote in January, I believe.
Correct.
That the market's going to go down 20%. And it went down 22%.
I believe he said 15.
Right? Or 15, okay.
We'll see a 15% pullback, which is kind of predictable, all right? So
at market highs, because that's where we've been.
Yeah. So, and I say predictable because this was coming out of the back where last time I came up to speak to you all, the election was still very fresh. We were pre-inauguration day or right around inauguration day. So we knew there was going to be changes. You're going from a Democratic administration to a Republican one. To these two administrations had nothing in common. And the set of chemicals that he has on the page right here are very potent. These are big things we're talking about changing. So I don't know that call was, so bold to say, hey, when you start playing with really big pieces of the economy, that something's going to break or scare the market.
But this is the atypical part, right, of things. Because usually, no matter if it's Democrat or Republican that comes in, we don't do all these things at once.
Correct.
You get somebody like Obama that picks on healthcare, and that's what they go deep on. And then they go so far in the paint, they get so beat up, they can't go deep on anything else, basically.
Right.
So then moving forward a little bit, we've made all those losses up, and we're higher.
A
little bit.
Yeah.
Nothing's really settled out, though, it feels like. Everything just feels...
Comfortably uncomfortable?
Not comfortably at all.
Well, we're not still down 20%, right?
I'm thrilled y'all manage my stocks. And I'm not saying that to kiss up. I genuinely have so little idea what to do right now. And it's making me... I'm sharing that with my clients. And I'm saying, look... I don't know what's a deal. Is Palantir a deal right now? Is NVIDIA? It could be, may not be. But I do know that New Orleans commercial real estate and New Orleans residential real estate are trading at, levels we haven't seen on the low bound for a while.
Yeah. No, existing home sales, definitely not the strongest part of the economy. So we're going to talk about today. Let me just level set. I'll show you a couple slides about what we did last year, where we are this year. We'll talk about some high-level, trends, themes in the economy, as well as maybe 2 or 3 ideas for, like, on the investment front, what we see as working. But
maybe you can make me comfortably uncomfortable.
let's see if we can get there. So this is last year. 2024, top-performing asset class was gold. But, yeah. So from there, we led the U.S., the rest of the world. Those light blue bars are equity markets. The green bar is a blend. And then the orange bars are commodities. Brown is cash. Orange bars are fixed income. So looking at last year versus this year. So top performing asset classes, still gold. But the rest of the world looks very different. So
what does it mean when gold is your leading asset class?
That means that people are looking for a safe haven and an inflation hedge. And one of the major themes I'm going to talk about today is that we are in a cyclical, not secular, decline of the U.S. dollar, meaning the U.S. dollar has been overvalued for quite some time. Tariffs and all that have a huge impact on foreign exchange reserves. People are looking for a way to get out of that trade completely. And gold stockpiles, when tariff wars kind of engage, you've seen more central banks around the world stockpiling gold. So there are other buyers of that asset class that are driving it up.
Is it typical to see stocks, gold, and bonds at relative highs?
All at the
same time.
No, it's something of a rarity, but I don't think bonds are there in terms of being near all-time highs. Actually, compared to where we were a few years ago with the rate environment, bonds still have a ways to go. 2022 was the worst year for bonds in 40 years. So, bonds are still recovering from that. My mic is off? I'm green.
No, it's on.
You got a different green one for me?
Oh.
There you go.
Here. You can keep the microphone.
I'm not undressing for this whole revolution.
Do this. Let's move to this side.
And this is
Cool.
Dun, dun, dun. Yeah, I want you to screw it in. Beautiful.
Please hold.
Boop, boop, boop.
How's that? Am I doing any better for the folks on the line?
On the line? Wow, I talk louder than... Go, talk again?
Hello, hello.
Yeah, you're on.
Okay.
Put it in this pocket.
Cool.
Maybe your body was...
Blocking. Cool.
All that solid muscle blocking the radiators.
So from what we're looking at right now, this year looks very different than last. The one that I'd jump out or point out to you is that global equities are up something like 7% this year. Europe is up 20%. Emerging markets up double digits. So if you want to read the equity markets on how the trade war is going, there's certainly been more of a rally in international stocks.
And Europe was negative last year, according to that gray bar, right?
Mm-hmm. Slightly.
We've outperformed Europe through the whole recovery, through the whole post-COVID, through
Right.
COVID up to now, we've
really
way
last
outperformed.
Decade. Last 10 years, it's been S&P has been the place to be, but things are changing. So one of Michael Semblus' comments is the worst thing we could do is mess up this conversation so bad that Europe wakes up. So Europe has cyclically, for decades, underinvested in their own economy. They've been fiscally very conservative. They don't spend the way that we do. They don't grow the way that we do. They don't have major advancements on the AI trend. They don't have the major industrial or military manufacturing that we have. And now what we've seen and what came out earlier this year is that the Germans, for example, passed a $500 billion bill to enhance their own economy on military spending in particular.
And these are people that hate budget
They
deficits.
they run like a
hate debt.
60% debt to GDP ratio, very fiscally conservative, notably so, and they're changing their tune because they no longer believe they can rely on the United States as an ally, that Donald Trump is not going to stand up for Ukraine the way that they'd like to, et cetera, et cetera. So they believe now that they need to reinvest more for themselves. So you've got a couple trends happening all at once. Number one, they're reinvesting more heavily in their own economy. And number two, I mentioned that U.S. dollar trade earlier. When you're earning money in euros, and you convert that back to US dollars, if the US dollar weakens, you've enhanced the return on your investment for that particular investment. So it's not terribly hard where, for example, if Europe went nowhere from here, European stocks pay a higher dividend on average than United States stocks do, something like 3%, whereas the US is down in the ones somewhere.
So money managers, big banks with access, can go open an account that's not dollar denominated. They can open a European trading account, convert their dollars to euros.
You can just buy a European stock.
Or just go buy a European stock.
You can buy Novo Nordisk instead of Eli Lilly. Both
What does Novo Nordisk make, and why are they popular?
Well, so Novo Nordisk is the maker of Ozempic, which is obviously a global product. Or you buy Ferrari or LVMH, which makes products sold around the globe. But when they report in dollars and they pay their dividend in euros, and you convert that back to dollars, you get a sort of boost on your return there. So, okay, that's only to set the stage, just to say this year has not looked like last year. U.S. stocks up, this is a little dated, it's just under 2% so far year to date, but not down. For the amount of change that we've seen, and conflict in Iran, and conflict in Israel, conflict in Ukraine and Russia, like the amount of fear that's out there in the market about change, the amount of discomfort we're all feeling, still up year to date.
Everybody.
So that's the comfortably uncomfortable dichotomy of like everything feels like it's squirming under the surface, but on the top level, not the worst year we've had. So that's again just breaking into, and the slide that I'm probably going to keep putting up here every single time. There's always a reason not to invest. There's always a reason to be afraid of the market. There is always something going on in the world. So this is the return of a 60-40, 60% stocks, 40% bonds, globally diversified allocation since Y2K. And you can see that every year there was a scare, a global conflict, a change in policy, a natural disaster, a something that was a reason to be afraid. It's not a reason not to invest. So let me just, for all of you who are investing your own personal assets, your retirement accounts, whatever you've set up for your kids to fund college educations, those things that are invested for the long term should remain invested for the long term. So caveat everything I'm going to say today with that as your underlying principle.
Put it in JEPQ and forget about it?
Maybe. So the outlook. This, when I brought it to you in January of this year, we had the lowest recession probability that the private bank even allows on any of these recession trackers. It was 10%. That's the lowest you're ever going to hear us say it. That has increased, and that has increased largely on the back of policy changes, and tariffs is a major. So tariffs are a drag on the economy. They're inflationary. They're generally not good for economic output. And so when we were having this conversation...
that sounds like a political statement. You deal with a lot of people in the whole political spectrum.
We try to say that, and we reference back to a piece that was written by one of our chief economists, Joe Seidel, that is saying that clinically, academically, in theory, what tariffs do is they slow the economy and they increase the cost of goods.
The bill is due by the person that ordered the goods at the dock.
Well, but just when you think about it, when you increase the underlying cost of goods, that reduces the demand for those goods.
Okay, even simpler.
But yeah, I mean, that's it. It's just,
Not political.
Right. It's not meant to be a political statement. Tariffs do certainly have their uses. Tariffs are primarily and best used to steer activity. When you have, you want to make sure that the U.S. has steel production or semiconductor production onshore. You use tariffs to protect your domestic supply of those goods and make sure that we're not being outcompeted by somebody flooding the goods with cheap steel or something of that nature, because you believe it is strategically important to have some amount of steel production in the United States. Fine, that's good. The policy that we've seen so far this year, which was of, I'm going to keep moving forward, broad tariffs. So this was the conversation. When I last was in front of you, you can see the tariff rate was in the low single digits coming into this year. We started talking with the pre-liberation day, 10% on this, 10% on that. That was the blue dot on this line. April 2nd was quote-unquote Liberation Day, and at its worst, we thought we were going to have a tariff rate somewhere in the 23% range. But Donald Trump stated that he was open to cutting individual trade deals. He knew that wasn't going to stick as the long-term tariff rate. So we had this green bar of the estimated range. Right now, it seems like we're trending towards the lower end of that estimated range. This is to say that part of the reason why things panicked in April, we saw that 15% sell-off, is because we jumped from the blue dot to the orange dot, and that's really scary. Like, this chart goes back to 1900. Like, we're not talking about recent history. We're talking about something that we have not seen in 100 years. So the markets freaked out, kind of reasonably so. And the more we're moving back from that orange dot to somewhere in that green range, they said, okay, we can deal. So the impact of that is that we came into this year with an economic outlook of 2.5%, 2.8% GDP growth rate. That's now been reduced to 0.5% GDP growth, not recession. So actually, for a moment in April, when we thought we were going to the orange dot, our base case was 50%-ish likely recession. So the more we come down off this range for tariffs, the less that sort of recession seems likely. And at the moment, we think things are being negotiated at a rate that will avoid recession.
We have a weird relationship because we want rates to come down. Mm-hmm. We being realtors, right? So when you say that there's a very low, there's still less than a 30% chance, 30% chance of a recession, that would indicate a stronger, longer rates.
Well, let's pause.
Right?
Hang on.
Okay.
That's not necessarily.
Right.
We'll get there in a moment.
Because growth is moderating at the same time, and then we've got wages that come into that.
Correct. So growth is slowing, and make no bones about it, we do believe that the Fed policy is still in restrictive territory. So GDP growth, as it is slowing, at some point the Fed is going to want to take their foot off the brakes. To your point, that's not the same as hitting the gas, right? So just taking your foot off the brake is not the same thing as hitting go. So the Fed still needs to, we believe that rates are currently above the neutral rate, and so the Fed is at some point going to find that neutral rate. Let me keep moving quickly, get through a couple of these. Yeah. So the other thing that's underpinning the stock market versus the economy, we got to talk about these two things separately. So on the left-hand chart here, you're looking at corporate profit margins. On the right-hand side, you're looking at private sector debt, which is both corporate and household. And so margins are fairly high and debt levels are actually quite low, which means when something like tariffs comes through, the economy can kind of take a punch right now. We were not in a super fragile economy that got hit with tariffs. We were growing at one of the fastest rates that the United States economy had seen in a couple decades, frankly. So the economy has some ability to sort of take a punch right now, and that's exactly what it's doing. We believe that we will avoid that recession, but there's plenty of other policies that could impact that view. So back to my original answer of I don't know, that we've got a bill coming through the House and the Senate. We've got tariffs constantly being negotiated. We've got unrest in the Middle East. So the other thing is it's too soon to tell exactly how dramatic these tariff impacts will be. Retail sales haven't quite rolled over yet. Jobless claims are kind of within the range they've been for the past few years. Earnings estimates on the S&P still actually trending upward year to date because there's some pretty powerful trends behind that, things like AI and energy investment that are pushing things along forward. Any questions, thoughts from the room on that? I'm curious also what you guys see, think, feel on the consumer side. We'll get there. We also believe that part of there's a lot of noise in the data right now, so we have to look with these tariffs. We've got to look for the trend in where things are heading, and right now we've got a tremendous amount of noise because there was a lot of, when the tariffs were announced, front running, people trying to ship things early, get them here, so that the numbers are seeing huge swings in either direction. It's going to take a few months for us to get multiple data prints and see what shakes out here. The other issue with tariffs that you'll see on my far right-hand chart here, this is 23, 24, 25, Treasury deposits, collections from tariffs. You see this huge spike in April. You're also going to see an probably even bigger spike in May. We've updated this chart. That tariff collections have risen. So you should think that's great because that money goes into the U.S. Treasury. It can fund some of the other things, reduce our deficit.
Our debt.
Exactly.
Yeah,
It can go to reducing our deficit and reducing our debt. Great. The issues with tariffs as a funding mechanism for your government is that this impact fades over time. Where other taxes grow as the economies grow, people work around tariffs. They don't like them. If tariffs make things expensive, if it makes your steel expensive, then you're going to move the steel production onshore and stop paying the tariffs. And when you stop paying the tariffs, the collection volumes start to go back down. So the news, the headlines has been the Congressional Budget Office forecasting the total cost of these bills and these tariffs and things. And what you see with that is that they do forecast these tariffs weaning over that 10-year period. It has a big hit in 25 and 26, but slowly over time, people are going to find a way around the tariffs, even if that means re-onshoring, which is good for GDP, but not good for if you're relying this on a source of collections to fund your government. So that leads us to the budget bill. There's a lot in there right now. We've got a bill from the House. We've got a bill from the Senate. They are running this process quickly. And when I came in January, I thought we'd see some results on this in the third quarter of this year. They're trying to get it done by the 4th of July. I don't think they're going to get it done by the 4th of July. But it is important that we should look for them to do something before Congress's August recess. So what happens in August is all the Congress members, House and Senate, go back to their home jurisdictions, and they go to these town halls, and they're still working, and all their constituents yell at them, and what are you doing, blah, blah, blah. It's harder to get this one big, beautiful bill passed after you come back from that recess. And, Congress members have been yelled at by their constituents until they're blue in the face. So if we're going to see this get passed, we think it's more likely that it happens before August. So maybe not July 4th, but end of July, I wouldn't be surprised to. And the House and Senate bills aren't too far apart at the moment. You can see just for scale, the permanent extension of the TCJA, which is the 2017 tax bill from Donald Trump's first administration, is pretty expensive. The additions on top of that are a lot of the conversations that we're having about no tax on tips and no tax on overtime and all those new benefits we're trying to throw in. It makes the bill expensive, and then you offset that with the reductions in taking away clean energy tax credits, funding cuts to Medicare, Medicaid, whatever they can do to sort of trim expenses there. The net number that just came out this morning was a $3.4 trillion cost over 10 years. So we will see what the ultimate bill gets passed, and we will also watch the bond market's reaction to this, because at some point, anytime you see us continuing to expand the deficit, eventually U.S. Treasury bondholders are going to say, no, we're out. That's not a good plan. And so you will see the 10-year yield go up pretty dramatically if that is the case. We haven't seen it yet. So as long as the bond market is willing to stomach this sort of deficit, as long as the markets believe that the growth caused by these tax cuts will offset the deficit growth, then the plan can pass as is. But the House, the Senate, they will be sensitive to that cost of government funding. So
your kind of quick point of view on how Treasury auctions have been lately? Kind of
mixed
so-so?
bag. Yeah, mixed bag. Some really good, some not. I think we've struggled with some of our 30-year auctions, but we had a pretty strong 10 and 20-year recently. So remains to be seen. We're watching carefully, and I think the markets are watching this carefully. So
just to bring you all along here, in case you're not familiar, the government literally goes out on a day that they say, hey, we're selling, like, what's the tip of, they'll pick $10 billion of bonds for 10 years, and let's find a price there's pricing guidance, and then based on how many people say, yeah, I'll buy that drives what the auction process, just like any auction. So you can actually watch on CNBC after these auctions, and Rick Santelli will get up there and he'll say, I grade this like a B. There was pretty good, there's a lot of market participants that had demand for 10-year treasuries today, and that's why you saw it dip. Or not a lot of people showed up, and
it matters because you watch the mix of buyers change. So traditionally, like foreign governments are large buyers of U.S. Treasuries, hedge funds and pension plans are large buyers of U.S. Treasuries. So you watch too for the mix of who is willing to buy U.S. debt and ultimately fund our government and fund this plan. So it's an important mechanism.
Because we're at about 114% debt to GDP, right?
Sounds right.
Yeah. Which sounds really terrible for people who are running a typical household. In the government world, that's not so bad.
Yeah. I mean, it depends on who you're
Japan's
comparing
like
us to.
245, right?
Right. And then some of the most fiscally conservative guys in Europe, the Germany and the Netherlands, and those guys are, 70, 60%. So it depends on who you're comparing yourself to. But as long as the interest expense doesn't get too high, as long as the cost of funding our government, at some point the interest expense starts to dwarf the things that we're actually spending on healthcare or education or anything like that, that's when the situation becomes untenable.
And the real reason the U.S. has been able to do this for so long and run a deficit like that
is because we are the global reserve currency.
And our GDP keeps growing very stably. And we've never done anything to screw that. We've never done anything to extinguish that fire, right?
Right.
We're always adding logs to the fire. That debt is to help fund more and more revenue.
Exactly to my point when I was saying, if the bond market thinks that we get enough growth from these tax cuts, sure, the debt goes up, but if the GDP goes up too, the ratio won't go crazy. So that looks like a sustainable plan. But that's why, back to your picture at the beginning, when you throw tariffs into the mix and you throw these other things, these are dangerous chemicals that we're playing with and they don't mix terribly well. When you throw tariffs into the mix and you demand that people re-onshore all of our manufacturing so that we get, production of goods in the United States, but then you deport the largest number of manual labor workers who fill most of those jobs and wage cost spikes. Like, we're playing with dangerous chemicals here. We just need to do it responsibly. Donald Trump changed his tune slightly recently, demanding that ICE not raid farm physical. Correct, because at some point, if you run into a wage and labor issue, the rest of this plan doesn't go. So,
just like on tariffs, there's some things that we just can't produce here at all, and there's been a lot of line item adjustments.
Yeah.
Right.
So we're watching for the mix of chemicals that are going into the pot for this economy right now, and right now things are trending in a comfortably uncomfortable. Like, we're still messing with dangerous chemicals, but it seems to be sort of working so far. Just talking about what could work. So what do I buy? What do I do? What looks okay? Broad market, we don't have huge expectations from here for the S&P 500 into the year end. So as a whole, U.S. stocks, probably not doing a ton, but there are pockets of the market where you may see some interesting opportunities. One area is in the financial sector. So post-2008.
Wait, let's just remind everybody. We compete with the stock market for investment. What did he just tell you? The stock market is going to underperform for the rest of the year. If you're looking for something to text a client or talk to a client who's on the fence about buying investment property right now, that is the conversation that you just heard. You can tune out for the rest of this. No, I'm kidding. But that is a huge takeaway.
Right. People are always thinking, what's the best next thing that I can do with $1? So I get paid, you should be getting paid 4%-ish on your cash in a money market fund or something. So that's sort of like your baseline. I can take very little risk.
That sucks to compete with, quite frankly.
That's terrible. So that competition won't go in until we see the Fed rate cuts.
Because 4% is traditional real estate appreciation, right? That's not the income portion of it. That's just the appreciation of the asset.
And I think you guys compete more with that cash rate than you do with stocks.
But I completely agree with you. I think that is but there's a sizzle conversation, and I think the stocks are the sizzle, and then when you get to the meat of it, it's, well, I could just go buy a CD and get 4%. It's like,
Right.
oh.
Why am I,
Right.
maintain this piece of property?
Right. And then we have to explain that you only need 20%
That you can apply leverage
cash
and get more.
because
Right.
leverage will get you a bigger asset.
So hang on. All right, let me hit these three really quickly. Financial sector is probably due from some deregulation. My own boss, Jamie Dimon, has been out there very vocally speaking about this. Since 2008, we've wanted to make banks safer. They needed to keep more capital in reserve, more cash on their balance sheet to make the banking sector more stable. And they needed to de-risk. They needed to do less risky loans, no more stated income mortgages, no more lending to super risky business ventures. That's moved to sort of the private credit market. And we're keeping more and more and more cash. The requirements that they had for us every year would increase. And it's gotten to the point where like banks are sort of walking around like one of those kids that's wearing too many snowsuits and just like too much padding at this point. And so the conversation is about reducing those capital reserve ratios so that banks can be a little bit more flexible with what they do with their cash. If that happens, that frees up a lot of cash that banks, insurance companies, et cetera, can return to their shareholders, buy back their preferreds, buy back their own stock, increase their dividend, make more loans, do more, build more branches, whatever it is they want to do.
And like a simple thing they're asking for is just that they could count Treasury holdings of U.S. Treasuries as cash.
Changing what it's considered in our CET1 ratios. It's all very suffice to say, this could be very good for bank stocks. It could also unlock bank mergers, which have basically been on pause. You have not seen very many
mergers, yeah.
And so smaller banks could be bought by larger banks, and that activity could be a boon sort of for the economy and for those stocks. So the finance sector, definitely one to look at. The dollar, I've hit on this trade twice already. We're looking for some cyclical underperformance. Call it 3 to 5% decline in the value of the dollar. If you're thinking about traveling internationally, it's going to get a little more expensive out there when you're abroad. But that does mean that all of those funds earned abroad, when they're returned here, if you can just get 3 or 4% dividends in European stocks and 3 or 5% decline from currency, you could be making high single digits in European equities without doing very much from here. And then finally, AI. AI is the big trend. One of our sections in the mid-year outlook is, why isn't anyone talking about AI anymore? Because we're making a ton of progress. So the trends that are very investable are both in the actual AI producers, the hyperscalers. These guys are showing real margin expansion, revenue growth. It's a real product that they've got. There's large new data centers online. The last time I was here, we were talking about Meta's $10 billion facility in North Louisiana. We just this morning got our first economic impact survey of what that is doing for the economy around Monroe. Hundreds of jobs created, thousands of guys on the site. It is very meaningful, very material. And then on top of the actual data center, Entergy is building natural gas turbines, and Meta has actually committed to calling it a clean facility, so they're buying an additional amount of clean energy on top of what's being generated to offset the natural gas production. So Entergy is now building like solar farms all over various places in rural Louisiana. So
and to negotiate it all, I hear they had to also make grid improvements that are just. There's all these downriver commitments.
They're fixing roads. They're funding all sorts of.
There's all these downstream things that are just. Nice.
So the economic impact of this is big, and the numbers are real. Real revenue is being produced by this. People are finding real value in using this so far. It's a trend that's going to continue, and it's still pretty investable. Across the tech
and we
sector.
probably got this because Mike Johnson is Speaker of the House and Steve Scalise.
It doesn't. It doesn't hurt that we have.
And we have a regulated energy market. That was the kind of other big thing. They can predict their costs.
3 themes that you got to look into the subsectors of the market. Think international. Think financials. Think about investing in AI, both the actual technology producers as well as some of the energy guys who are funding that build out, as well as general infrastructure. Okay, let's get real quick on the economy. You've been dying to hit this point for a second now. We are underway of a global easing cycle. So the Fed started cutting rates last year, but then we went on pause, and we really haven't seen any further movement in the last 6 months, more than that. And so we're waiting for the next Fed rate cut. Our expectation heading into the end of this year is that the Fed will give us 2 more rate cuts. Right now, the base assumption is the first cut will come in October, with a second cut before the end of the year, and then maybe 1 or 2 more cuts next year. So like I said, we're trying to take our foot off the brake a little bit, and lower those sort of cash yields that I said is your sort of primary competition here. So that is the outlook on the Fed. The ECB is ahead of us. They are charging ahead. They continue to cut rates, and they've been moving a little bit more quickly than we have. In Japan is economically like another planet, and they're like moving in the opposite direction of everybody else.
They're above negative. Give them, like, for the first time in like decades, to give them a round of applause. I mean,
they're going in the opposite direction of everybody else. And
well,
so,
they've had a whole other problem set, right?
So this is just, again, what determines when and how the Fed cuts rates. You look at, their 2 mandates are inflation and unemployment. Inflation is coming back into the line. Most recent PCE print was around 2.5%. Their target is 2. That has not changed. There was a lot of chatter about them changing that target, but it hasn't. And then their unemployment target is 4, and we are at 4.2 at the moment. So they're going to be watching to see whether inflation continues to come down. Tariffs also play an impact on this, so the next few months of data is very important to see whether this trends back towards that 2% number and whether unemployment remains steady or holds with their target.
So high tariffs could actually screw up the
ability to cut
inflation.
rates. Correct. If tariffs raise inflation, that harms the Fed's mandate and their ability to cut rates.
Do you have any more labor? Yeah, you do. I remember you have a labor sign. There we go.
There you go. But the labor market's not showing tremendous signs of weakness. Unemployment's ticked up slightly off the lows, but it is at sort of the target rate that you would want to see for it. When the unemployment goes too low, you get too much friction in the economy. People can't hire. People can't expand their business. And it actually ends up slowing the economy when the labor market is too tight. So you want to hang around that 4% number. And then really there's just been stability across the rate of wage inflation. Wages are still growing faster than inflation, which is back to being a good thing for the average guy working. For sort of the middleman in America to do well, you want labor wage growth to be higher than inflation. And that's what we're seeing right now. So you want to see that trend continue.
I think this is I think when we talk to you in January, this is going to be the whole, like your whole deck. Instead of being one side, labor is going to be a lot heavier.
We will see. Again, it depends a lot on whether our deportation tactics or immigration tactics change.
100%, and that's why, because there's too many things playing here. And if we lighten up on all the deportation stuff a little bit. And I'm not saying lighten up like accept it. I'm saying if ICE slows down, okay, if the White House pulls their policy back, which is what they seem to do, they put something really big out and then they pull back. Then I think we would see. You're hearing a lot of publicly traded companies right now offering buyouts, especially in tech, which Google is doing it. I mean, that is crazy that Google is now saying, hey, first they say return to work, and they see what they get back. That's their first way of cutting jobs. Then they say, okay, we're offering buyouts to people to leave. We'll give you 6 months of pay if you quit now. Interesting. I think then they're waiting to see what happens with the economy. They're waiting to see, do we go to layoffs next?
It is a small subsector. So in early 2024, we were talking about the Patagonia vest recession. So like 2 times ago over here of like
but
tech
those are your people. Yeah.
Well, no, that was the tech sector.
Finance,
that was Meta and
tech.
Google and those. They were announcing layoffs. They were cutting people left and right, and people are like, "This is a sign of recession," and actually, it was quite the opposite.
They had overhired.
There's a little bit of a microcosm there.
That was the friction point you said about.
They hired quite a bit during COVID. Correct.
And they overhired.
So that is maybe on their end some of the power of AI and the amount of code that they're able to generate and write. They don't need as many coders anymore. But remains to be seen that is not what employs the broader part of the economy. And at this point, we're not in a place where AI is replacing many functional jobs just yet. We are still in a place where AI is enhancing productivity of existing workers. You're seeing some stress in like the just out of college crowd because there's not as much demand for new hiring, and those entry-level jobs are the first to be replaced by AI. So that is like where you're seeing the sort of, but right now AI is mostly just making the average worker more productive.
I can't believe it's changed in 3 months. The changes in AI that took from 12 months ago to now are unbelievable, but 3 months might just be even more profound.
The reason we're saying AI is an investable sector or an investable theme in the marketplace is because we expect that to continue.
Right. And dislocations occur, which allow companies to charge to have high earnings.
Mm-hmm. So the other thing is the consumer is generally healthy. I know last time everyone was a little concerned. If you look at this orange line on the right-hand side, that is the consumer interest cost as a part of as a percentage of income. That's like credit card debt. And that pickup was worrying. It's not at unsustainable or scary levels. And so far in 2025, it's kind of like flattening and leveling where it is. And so household incomes are still growing. So as you can see here, wage growth across Europe, Japan, the United States is all higher than the inflationary rate. So the consumer is a major underpinning of the U.S. economy, and at the moment is not in terrible shape from the high-level picture. But certainly subsectors are seeing stress. Young college grads probably feeling the brunt of it.
You seeing any HELOCs?
Yeah, actually, I just took my biggest home equity line of credit application ever, I think. And so, all right, this is your slide. So mortgage rates have come down, but the average rate of someone who is currently holding their mortgage is actually slowly drifting upward because as that activity happens, as people are forced to buy and sell their homes and get a new, that light blue line on the left-hand side moves a lot slower.
So wait, they bought in 2020 or 2021.
Or any time when they had that.
Right, or they refied.
Mm-hmm.
And we see that the average American stays in their home for how long? 5 to 7 years. The average New Orleanian, 7 to 10. So we're going to see this pan out. People just eat. I'm eventually going to say, I got to give up that 2.875.
Right. At some point, I need another bedroom. I got to change towns. I got to whatever. Like I just have to. And so that light blue line is moving very slowly. To the point on feeling your pain, the reason the housing market nationally hasn't gotten as much negative press, I think, is because the light blue line on the right-hand side, new home sales, is actually decently strong and trending where it was sort of pre-COVID and all of that. Actually, maybe even a little better. But the existing home sales is what you're feeling. And in the New Orleans market, there's not a lot of
I actually think on existing home sales, if you break them up, we're seeing we're seeing that the homes that were renovated recently, different color palettes, different, all the things, trade much faster, especially if we can get them price it right, trade much faster. And the discount that somebody with a functionally obsolete home, from a floor plan perspective or just, it's out of taste with today, the discount that we have to really, really work with them to take on the price, that they rarely do, those homes are staying on the market the longest. Is that fair? Is everyone kind of feeling the same thing? We just can't get those people to take the discount that the market expects of them to take an old floor plan.
My interpretation of that from everything else I told you today is that people are afraid of a construction job. When inflation has been high for several years, it's just coming down. Material costs are high. Labor is hard to find. You don't know what you're going to get. It's like a construction job just feels like
scary,
more and even more unpredictable because you can't. If you knew how to ballpark a job a few years ago, you maybe don't know how to ballpark a job today.
Yeah.
And so that's a bigger question mark for people that may make them a little more hesitant. Your sellers might want to consider doing some of those changes themselves. Not only that, but when cash is scarce and home prices have risen to a point where it's sort of unsustainable, your average first-time home buyer in the United States, 38? 38? and like you're just barely scratching enough to like get that down payment together, when you close, you probably don't feel like you have a ton of cash left over to then go make changes or improvements. So that tracks for me from the other trends we're seeing in the market.
Sure.
Last thing I'll close with is my own mortgage rates. I did a decent guess last time. I said the 30-year we wouldn't see much movement, but that our ARM products are something to focus in on, because especially towards the end of this year, you see more Fed rate cuts. The ARMs are now in the 5s with a 30-year in the low 6s.
And this is jumbo only.
This is jumbo only, and obviously the way that you read my chart here is that in the private bank we offer discounts for clients who do more deposit and investment banking relationship with us, so that 3 to 10, 10 to 25, that's how much in assets those people tend to keep with me. This is more applicable to people with large relationships, but these are where our rates stand today.
But it's interesting that you can be... I mean, the idea if you're taking an ARM, because it's a much safer product than it used to be, right? Mm-hmm. The idea if you're taking an ARM is, well, 5 years might get me, I can save this much money per month, and within 5 years, the interest rate environment should change a bunch.
Right.
And I should be able to refi.
And the way
that, right?
our ARMs work, adjustable rate mortgages, all of the loans that you see on this page, except for the 15-year, are 30-year amortization. So all of the loans are for 30 years. After 3 years or 5 years, your rate may float up or down. So if you pick that 3-year ARM, and 3 years from now it starts to float, and the Fed has cut rates and things like that, your rate may float down in 3 years. So maybe you're more comfortable with that. Or if we're in a better rate environment, long-term yields are lower, you can refinance it at that time. So it gets locking in your 30-year today is not appetizing to me. If I were a buyer and I was going out on a home, I'd be looking at a 3 or 5 year ARM, and then talk to your banker, see where things are a couple of years from now, because that rate environment is likely to change.
What we know is that 6% is kind of a magic number in housing across the country. And whenever we could show a client, hey, look at this good news, this is where things are trending to, we think you could be, first of all, if you're a high net worth individual, let me make an introduction for you, or we can try to do that. You could try to get that through your people. Here's the sheet that the guy came to the office with today. But I also think we're setting people up for a buy in October as well, when a rate cut should start to happen. Mm-hmm. People starting search now, that would not be crazy for a big fourth quarter. Right. That I think could be here. But you've got to start making calls now. You've got to start warming those relationships now, because people don't just wake up and say, I'm going to buy a house today.
Right. And so the other thing down at the bottom of the page is the home equity line of credit. So that's a 10-20 HELOC. That means you have a 10-year draw period. You can draw it down, pay it back as many times as you want during 10 years, and then it amortizes over 20 years after that. I've got a guy right now, again, I've actually taken 2 or 3 of these applications, who they're putting the home equity lines in place on their primary or secondary home to buy a third or something else to take advantage of that, because that is a true floating rate. So when you see the cuts, you will see that kind of come down.
Oh, interesting.
And also just, people like to be able to tap into their home's equity, especially if values have appreciated a lot.
Yeah, there's a lot of equity out there.
Yeah.
Okay. Questions? We got a couple minutes here.
I'll do one quick question. You talked about deregulation of big banks. Do you have concern of regional banks, and any comments on office real estate, which isn't as applicable here, but are there still those fears?
It's trading, though. Office real estate, like big downtown. Gail Benson just bought one, and the other 1515 just traded yesterday too. We were just that
was her.
1515 was her, and then the other one that just traded 1615 was between our last 2 meetings.
Yeah, but who bought that?
Out of towner.
Yeah.
So big commercial real estate is trading. This is, as I called it maybe 2 times ago, a car crash in slow motion. These properties are defaulting as their rates come due, as they have to refinance, and so they're not all hitting the markets at once. And we're starting to find a clearing price as people accept what the market value is on those. We think that crisis that happened in 2023, and again, really in 2024, the small banks that were most at risk went down.
Okay.
I mean, First Republic, Silicon Valley Bank, those guys.
Signature.
It's Signature. So like, crisis kind of happened. The folks with the most exposure and the most risk there felt it, did go under. We're not as worried about it as a sort of slow burn for the next 3 to 5 from here. And not only that, but if things are deregulated and a small bank gets in trouble, a big bank can swoop in and buy them as they historically would and save it from completely collapsing. But the problem is, like, we had to cut a very special deal we actually bought First Republic, and that would have normally not been allowed because our hands are tied in terms of how much deposits we're allowed to hold. So, yes, deregulation, I think, is more supportive for small and regional banks because it allows that additional flexibility.
Y'all are always at your max deposit until there's someone in crisis.
And then the federal government asked us to step in, and we were actually not the lowest bidder for First Republic or the highest bidder, but they would have rather seen that get added to our balance sheet because it doesn't move our risk.
Okay.
I can ask another question.
Yeah.
If anyone else has. Seemingly, we're becoming more of a war machine, right? And I haven't seen numbers on this, and so it's not like a proper lead-in, but like what is going on in the Middle East, what potentially going to increase, even what we've done in Ukraine. What effect does that have on current? Is there an idea of future impact?
That is, if I was going to put a fourth slide up here, it's an odd theme for me to talk about, but defense spending. And when we talk about defense, it's not literally just military spending. It's cybersecurity, it's supply chain defense, like all of those things. There is going to be a large uptick in the amount of defense spending, not only because of global conflict. People have to restore their stockpiles of missiles because there's a lot being fired right now, but the European economies increasing the percentage of their GDP that they spend on defense is real. That's a very real and a very big number, and that's something that's going to play out in both the European economy as well as in the United States. That is, yes, absolutely. And the advent. So one of the most important things that goes there is not only the actual device, it's the supply chain to get that device. So you've heard a lot in the news about rare earths being refined and imported from China. Those are critical for some of like the magnets and things that go into
automobiles, jets.
Yeah, jets, a lot of things. And so the entire supply chain, when we talk about defense, it's not just the end product of a jet or something. It's everything that goes into that. And we're looking at a major shakeup in those supply chains. So there are the comfortably uncomfortable, just trying to wrap this up. There's a huge pressure in both directions. You've got tariffs and things that sort of weigh down on the feeling of the economy, and then you've got AI and defense and other things that are driving things forward. And those two things have made the market not move a ton this year, but there's immense pressure from both directions. And I think if either one of those gives way, we'll see a major move, but our call heading into the end of the year is probably for a little bit more stable from here, but not a huge amount of upside.
All right. Well, Antonio, we always appreciate your point of view. Thank you. All right. We're gonna go quick. John, would you like to